Hi, welcome. Our pathway for members involves familiarising them with the sectors, the ASX sectors. This provides a basis for building a strong, diversified portfolio of blue chips and small caps. I'm going to go through the sectors quickly in alphabetical order. So the first one, consumer discretionary, are basically retailers that benefit from improving consumer sentiment because the products they sell are not necessities. On the ASX, top performers over the years include the jewellery retailer Lovisa, electrical retailer JB Hi-Fi. Harvey Norman has been a mainstay of this space over a long period. Because the key driver for Wesfarmers is hardware store Bunnings, we include this stock in the sector as well. The earnings from these companies, as I just said, are highly cyclical, so they ebb and flow. And rising interest rates is a factor in terms of the demand element, so that can depress demand. So the key drivers are store rollouts and growth within the stores, or same store sales. So it's a competitive industry, as we all know. So you need to include small caps because they're growing from a smaller base. Stocks we've made money from here include Kogan and Nick Scali. Moving on to consumer staples. These are generally supermarket retailers such as Woolworths and Coles. They're able to churn out profits no matter what the economic conditions because the products they sell are necessities. The big risk factor here is paying too much for earnings because earnings will never really shoot the lights out. But increasingly, another risk is technology. There are big costs involved in revamping and modernising legacy systems. So moving on, energy. The biggest company here, Woodside Energy, after it merged with BHP's energy assets in 2022. Biggest driver, obviously, energy prices, namely the oil price. The Woodside, before its merger, made a virtue of paying out a lot of its income in dividends. So it led the way there. But having said that, there's oil price risk and there's increasingly asset risk because investing in fossil fuels is getting harder. So we find there's more opportunities in the small cap energy space. Financials and banks. Well, you can't go past choosing one or more big banks when you're building your core portfolio. I'm talking CBA, NAB, ANZ, Westpac, Macquarie Group. They're one of the big engine rooms on the ASX. They're reporting right now, so it's fascinating to watch the pressure on both lending rates and margins. So to compensate, we're seeing a lot of these companies ramping up capital management, dividends, share buybacks. The big banks have ultra strong balance sheets, which they're working harder. Also in financials, we have the wealth sector, the wealth stocks. These are businesses that manage people's money or associated with the administration and the settlement of managing money. The biggest one is obviously the ASX, which is a listed entity that operates the Australian Securities Exchange. Other examples, you might be familiar with AMP, Challenger, Insignia, health insurance provider Medibank, private. The state of the investment markets is a big determinant on the profitability of these companies. Right now, conditions look good, but you have to make sure you're not paying too much because investing is about the future. Healthcare, a great sector for getting earnings that don't relate to the general state of the economy. But you have to be careful about how much you pay for this. The biggest in this space is CSL, provides blood-related products. CSL's, well, if it's highest for a number of reasons, which we cover in Blue Chip. Industrials, on the ASX, the big ones include Transurban, Worley, Qantas. Obviously very different companies. So the drivers here are highly varied. Transurban, toll roads, pays consistent distributions. Worley, consultant energy. Qantas, it's all about tourism. So IT, this is an underwhelming sector on the ASX when you compare it to the big ones, the Mag 7 on the US markets, Facebook, Apple, Netflix, Google. But we still shoot well above our weight in this space. So they're relatively big companies in the sector, but we find small caps are more exciting for exposure. We picked Afterpay, we picked Macquarie Technology to name a couple of stocks where we've made good returns. Materials. Well, this is really, quite a big space actually, because the materials here, we include manufacturing companies and paper and packaging companies. but materials can also include mining. But in our definition, these are the likes of Amcor, BlueScope Steel, James Hardie Industries, and Boral. Even though I think Boral's on borrowed time, it's been taken over. So these are all companies whose products are sold globally, leveraged to global growth, construction activity. Metals and mining, this is the other big engine room of the ASX beside banks. The big participants, BHP, Rio Tinto, Fortescue. For all these stocks, the big driver is global growth. They are also building track records for paying out dividends. Telecommunications, mass consolidation here. What's left? Telstra, TPG. Both well-run companies. Telstra's still the gorilla. Earnings are highly consistent, but again, watch out for how much you pay, and needless to say, there's technology risk. Real estate, a sector in transition. You might have exposure via your house, but it's important to obtain access to productive assets that actually pay income from differing tenants. And that's where real estate comes in, or the property sector. Lend-Lease owns and develops properties, trying to turn its business around after a series of cost blowouts. Utilities, these are good ballast for a portfolio because they pay good income. They pay strong dividends traditionally. But, there's also disruption. So AGL Energy, APA Group, these companies are, at the cutting edge of, the energy transition that we're seeing. So you have to actually watch them a lot closer than you think. I hope you've enjoyed listening to our ASX sector review. I'm Richard Hemming from Under the Radar Report.